episode 3 of the Wall Street Journal. I am your host, Tony Dundas-Luca. We have a lot to cover this week, thanks in part to a little bit of volatility coming into the market. We're going to start with a deep dive into all things VIX. So that's VIX, VVIX, VIX futures. I want to highlight specifically a little whisper we got from the VIX complex that gave us a little tip of the cap that or rather kind of showed its cards that something was a little off on Tuesday and that there was potential for volatility to start to ramp up into the end of the week. So we're going to look at that first. From there, we're going to take a look at fixed strike volatility, what that is, why it's important, and another little signal that my fixed strike vol skew measure gave on Thursday after the sell-off. From there, we're going to take a look at one important measure of liquidity that I watch. If you used to read my Substack weekly notes, you'll be very familiar with this. From there, we're going to take a look at Treasury market volatility, just a quick peek to see what's going on in Treasury markets. We're then going to move over to credit markets because there's a couple things going on there that I think are worth taking a look at. And then we're going to end with two new sections. The first one is called This Week's Tweets. In that section, we will be reviewing a few of my social media posts from this week that I thought were important and might need additional explanation. And then we're going to round things out with another new section called Tales from the Tape, where we take a look at some price and volume action when there is some that's relevant. And there was some this week that I think gave an interesting read on what was happening during the market sell-off on Thursday. So anyways, that's where we're going to be going today. Thanks for coming along on this ride. Before we get started, we need one little quick disclaimer from the attorneys. So when that's done, we will be right back. All right, thanks for reading that. We can now move ahead and take a look at some market stuff. Let me get my mug out of the way. We'll see if this keeps going. All right, so this is my primary volatility VIX dashboard. For those of you who have watched these videos in the past, you will be very familiar with it. We're going to start with a look at the VIX. So this top pane is the VIX itself. I currently have this on my intraday setting. So these candles each represent 130 minutes. That breaks up each day's session into thirds, which I like to do. The next pane down is the VVIX. We then have the implied volatility measure of all of the VIX options. So VVIX and this measure are pretty similar, but as I'll highlight in a little bit, when they diverge, it can be an important signal. From there, down below that, we have the correlation between the VIX and the VVIX. Normally they move together. When they don't move together and this correlation drops, it can provide interesting signals. I consider it pressure building in the system. And then down in this bottom pane is the price ratio of the VVIX to the VIX. So when the line is rising, that means VVIX is outperforming VIX. And when the line is dropping, that tells us that VIX is outperforming VVIX. So I find this important because oftentimes when VVIX is outperforming VIX, so in this case, in this example, if VIX is kind of moving sideways or down, but VVIX starts to climb higher before VIX does, it's another signal I look for that says that kind of pressure is building in the system. So we didn't really see any of that this week too much. So let's dive right in. I'm going to move out to the daily. So it was an interesting week. We started really things, I would say, kind of kicked off last Friday. So this candle right here is last Friday's candle. As we can see, VIX shot up to this level right here. This is the 22.5 level. I consider it a sticky level. I'm not saying it's anything magic or anything, but for whatever reason, VIX oftentimes kind of struggles to get above it. You can see that here, 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 you can see that here. You get the point. For whatever reason, 22.5 tends to be a level that VIX has trouble getting over. So last Friday, we got way up there on Friday morning sell-off, and then VIX pulled back and slid. This carried over into Monday and Tuesday, and then things really firmed up on Wednesday, and then we carried higher into the weekend. Then we're going to look at this later because this is Friday's candle from this week, where again we kind of pushed up to 22.5. Failed and came back down as the market caught itself. But where I want to start first is what happened between Tuesday and Wednesday. So what I'm focusing on, and actually I'm going to move over to a spreadsheet because I think that's going to be more useful. So bear with me while I pull this over. Okay, so this is a spreadsheet that I update every day. It breaks the session up into thirds. And what I want to highlight is this right here is Monday. This right here is Tuesday. This is Wednesday, Thursday, Friday. So what I want to highlight is that this column right here is VVIX, the measurement of VVIX minus the measurement of the broader implied volatility measure. So these two tend to track very closely. As you can see here, they tend to be very close to one another. When they're not, so when one of these cells in this column turns red, it's signaling to me that they are moving apart from one another. And what was interesting is that after the close on Monday, so you can see throughout the day on Monday, they were exactly the same in the first third of the day, they were exactly the same in the second third of the day, exactly the same in the final third of the day, but then at the close, the implied volatility measure, which you can see right here, jumped from 0.99 to 1.03, where VVIX actually dropped from 99.14 to 98.91. Now, sometimes this happens and it means nothing. The next day, they kind of right themselves and there's really no signal from there. But what was interesting is that when we opened on Tuesday, we saw this persist. You can see right here the difference. The broader VIX IV was 3.9 vol points above VVIX, and this persisted all day. So basically what this was saying was that the broader measure of VIX implied volatility was climbing, yet VVIX was not climbing as much. And so you can see the fact that these cells all right here are green. That means that VVIX was going up from one third to the next third to the final third. And we can see that, sorry, that was VIX, that was the IV. You can see it was happening here on VVIX as well, but the VIX IV was climbing faster. And so we had this kind of dislocation. Now, when it's just a one-off, like at the end of the day on Monday, it catches my attention. I do focus on it. I do kind of have in the back of my head as something to watch to see what happens the next day. And so then the next day on Tuesday, when it continued, that was a bit of a warning sign. Now, sometimes this will go on for like days and days and days and nothing really happens. So it's not like when I see this, I just immediately get long volatility or I think the market's going to crack or anything like that. But it is something that catches my attention. Well, it turns out that this was a one-day little signal. And when we moved into from Tuesday into Wednesday, what we see is that VVIX, which on Tuesday, it closed at 99.6. On Wednesday, it closed the first session at 104.18. So it jumped about 4 vol points and basically caught up to VIX IV. So you can see here, this was a negative 3.63. That means that VIX IV was 3.63 vol points higher than VVIX. By the next morning, after the first third of the session closed, they were back to even. So it was interesting to see this happen. I'm going to go back to the charts now. It's a little bit hard to see just because of it's relatively it's a relatively subtle change. But what I want to be looking at is right here. So this was Monday. This was Tuesday. And again, this pane right here is VVIX. So we can see on Monday, VVIX was coming lower, and Tuesday it basically went completely sideways. Well, if we move down here, you can see this blue line was climbing higher right here. So as this line was climbing higher, VVIX was moving sideways. Again, these are one third measurements of the day's session. So it basically VVIX moved sideways the whole day. Yet this IV measure, the broader measure, was climbing higher. And then from here to here is the jump from Tuesday to Wednesday morning. We see that VVIX jumped, and it basically caught up to the broader measure of VIX implied volatility. So when I saw that happen, that was like eye-opening. Okay, something's going on here. Now when that happens, I wait and see, well, does it actually mean anything? Or is this just kind of a basic little reset because VVIX was getting too low? but it's enough to put me on alert. So the rest of the day, Wednesday, not a lot happened. VIX kept moving sideways. VVIX basically moved sideways the rest of the day. The implied volatility measure moved sideways the rest of the day. But then things really started to kick off on Thursday. So on Thursday, we had a bunch of weakness in the equities. I'm going to move over to the S&P. So now we're looking at the S&P. These 3 bars were the Thursday session. And as we can see, we got heavy selling basically all day long. It cooled off a little bit at the end of the session. But there was a lot there that to make volatility measures kind of worried, I guess you could say. And I'm going to get into more of the details of what was going on as we move into other sections, because there was some interesting rotation going on during the early part of the week. And then we saw the mega caps at one point trying to hold things together on Thursday, but then they eventually rolled over. It was actually just 2 of the mega caps. I think it was Apple and maybe Netflix or Nvidia. I can't remember. But anyways, it was Meta. We'll get to that later. But anyway, so this is what I was seeing in the volatility complex early in the week. The important part was this divergence of the VIX IV versus the VVIX. And sometimes when those things happen, it can be a pretty powerful signal. Like I said, sometimes it persists for days before something happens. In this case, you basically got a 1-day warning and then things took off. So that's what was going on in VIX and VVIX. We're going to take a look now at this is the CBOE that does the VIX calculations. They have a 1-day VIX, they have a 9-day VIX, a 30-day VIX, which is the VIX you're used to reading. This purple line is the 3-month. This orange line is the 6-month, and the light blue line is the 1 year. So this is another way of kind of looking at the term structure. It's different than the VIX futures term structure. This is just kind of the various VIX calculations term structure. But what you want to see is these to be stacked the way they are. The 1 year volatility should be the highest. The 1-day volatility is usually the lowest. When they pinch together, like you can see here and here, those are usually signs of stress. When they completely invert, which you can see over here where the gray line's at the top and the light blue line's down the bottom, that's a sign of major stress, and those levels are very hard to maintain. But I keep a look at this throughout the course of the week to see how things are developing. And we can see we got a little bit of a pinch up here to close the week on Thursday and Friday. The shorter term measures all started moving together. The longer term measures actually held up pretty well, and we'll see that when we look at VIX futures as well. And interestingly, the increase... the movement between the kind of front of the curve and the back of the curve has actually steepened the VIX futures term structure a little bit, which generally speaking is a good thing. So even though we had some market stress this week, that the VIX futures term structure getting steeper is actually a good thing, as long as it doesn't keep pressing higher. So let's actually take a jump and look at that. Okay, so these are the 2 VIX futures curves. The red line is the close from today, which is Friday, November 14th, and the kind of greenish yellow line is the close from November 7th, which is last Friday. The reason I'm comparing these two is because if you remember, last Friday on the 7th, we had a big sell-off. And then this Friday, the 14th, we had another sell-off. So this is an interesting way to kind of see how the volatility market evolved over the course of the week. So this starts with the December contract. The November contract expires on Tuesday. For whatever reason, Thinkorswim doesn't always show the front month contract. It must take it off the screen when it gets too close to expiration. But so it doesn't really matter right now to look at November. Really, December is effectively the front month future. So as we can see, between last Friday and this Friday, the December contract has barely changed. When you go further out, so here's January, February, March, April, May, June, July, you can see that the rest of the curve actually lifted higher. So this is what I was kind of saying before, that the curve lifted higher, but it actually got steeper as well. Now, high and steep, higher is not great because it shows that there's some discomfort in the volatility market, but steeper is actually advantageous because if the market doesn't go into some deeper sell-off, this steepness of the curve is actually adds a downward pull on the VIX futures because the way it works is VIX, the actual calculation, which you can't trade in a healthy market, is generally below the entire curve. So December right now closed at 20.15. We can take a look. So this is the December contract, and this right here in this pane is actually the December contract minus the VIX. So the fact that this reading is only 0.06, you can see right here, that tells us that VIX, so spot VIX, is basically even with the December contract. So that's not great because we prefer to have some premium there where December, the front month future is higher than VIX. So then that's what creates part of that downward pull, is that over time, as long as VIX doesn't pop up to meet it, it moves lower. And so when you've got a steep upward sloping curve like this, you're looking all the way out to July of 2026, it's at 22.95 and the VIX is way down here at 20. So it's basically like, what was that, kind of 3 vol points above VIX. So over the course, assuming that like the VIX doesn't run higher for the next six months, or 1, 2, 3, 4, 7 or 8 months, which would be hard for it to do, this contract will, very likely move lower. And so this kind of upward slope, as you can see, as time goes on, these contracts, as long as VIX is down below the curve, will slowly grind lower. And that creates this kind of weight on the volatility market, which is why if you trade the VIX ETNs like VXX or UVXY, those products are constructed by the first 2-month contracts. And so this contango, this upward sloping nature of the futures, and that kind of steady pull lower towards VIX when the curve is upward sloping, that's what creates a really heavy drag on those VIX ETN products. So anyways, kind of to recap, I would say not great to see that the volatility futures, they popped up over the course of the week, but we're still in contango and the curve did get a little steeper. So assuming that the markets are not going to go on some major sell-off, which I don't know if they are or not, but if they don't, all we've really done here is created more premium to burn off down the road. Okay, so I think the next thing I want to take a look at is the fixed strike vol. And we went through this a little bit last week. I'm going to pull up that same spreadsheet that I showed you last week. It's a little bit noisy. You can just kind of focus on the graph here. Really, it's the purple line is the one I want to highlight. The purple line is my fixed strike skew. So it's looking at basically the implied volatility of a roughly 30 delta 30 days to expiration put versus a call. And generally speaking, put implied volatility, so kind of for lack of a better term, its price, the expensiveness of puts is higher, so the implied volatility is higher. The IV is kind of like the pricing mechanism than call IVs. And the reason is because when people want to buy protection, when you want to buy insurance, you have to pay up for it. And so what I'm looking for on a daily basis is I track up here our fixed delta implied volatilities, and down here just some calculations, and then down here I track fixed strike. And so fixed delta up here, you can see I'm always looking at the 50 call, the 25 call, the 10 call, the 50 put, the 25 put, and the 10 put. So those are the different deltas. On the fixed strike, what I do is every Friday I pick the 30 delta and the 30 delta call and the 30 delta put for the next week, or I'm sorry, for 30 days out, and I track how the implied volatility changes throughout the course of the week. And the reason this is important is it gives you kind of a cleaner read on how implied volatilities are actually changing. And the reason that's the case is because if you just look at, I'll just jump out here to around 30 days. Generally speaking, puts, like I said before, have higher implied volatilities. The further out of the money you go with a put, its implied volatility is going to be even higher. So when I want to look over here on the right side, these are all of the puts for the S&P 500, December 15th, which is about 30 days to expiration. And so look at this column right here. So implied volatility. Right here where it switches from yellow to white, that's at the money. So you can see the at the money vol is 16.02. The further out of the money you can go, you can see these levels go up. And that's because the market is pricing. If the S&P were to drop to this strike, 5,000, the implied volatility at the current estimate would be 45. That would be a massive sell-off in 30 days, which is why the implied volatility would be so high. So as the market moves up and down throughout the course of the week, as the price moves into these different strikes, the implied volatility is changing just by the nature of the price movement of the underlying. So in this case, the S&P moving just moves the price into closer to different strikes, where the implied volatility has its own characteristics. So if the implied volatility, if the price of the S&P dropped to 6,700, you would see we went from basically a 16 vol to a 16 and a half vol, all on its own. But we wouldn't have known if the volatility, the implied volatility of the 6,700 strike changed at all. That's why we look at fixed strike vol, because we're looking at the same strike all week long. Now, there are way more sophisticated ways to do this. I just do this as kind of a back of the envelope test to see what's happening in the market. So this week I was tracking the 69.20 calls and the 65.70 puts. Now, I used those because they were roughly the 30 delta calls and puts last Friday. Well, by Monday, when the market gapped higher, they were no longer the 30 delta call and the 30 delta put. The call was probably a 40 delta, and I think the put was probably a 20 delta because it was so much further out of the money. But anyways, what I want to highlight here really is what happened between Wednesday and Thursday. So if you remember, Thursday was the big sell-off. And so this right here, these two right here, are the calls going from Wednesday and Thursday. And as you can see, the call implied volatility on Wednesday closed the day at 13.5, and it closed the day on Thursday at 14.39. So it basically jumped up 0.9 vol points. Now that's not odd, even though it was a sell-off and the price was moving away from this strike. The fact that implied volatility kind of across the board was going up would help put upward pressure on call implied volatilities. So that's not a surprise. But what caught my attention was that the put implied volatility jumped from 18.52 to 19.23. So that's actually less. That's only about 0.7 vol points. So remember, the calls jumped by 0.9 vol points, whereas the puts only jumped by 0.7 vol points. So it sounds subtle. It's only 0.2 vol points, but it's showing you that the bid for these calls was actually kind of stronger than the bid for the downside puts. So to me, that caught my attention because it said, oh, maybe this sell-off it doesn't have a lot of kind of like thrust behind it. Because if people were really panicked, the jump in put IVs would have gone up more than the jump in the call IVs, but that wasn't the case. So that change actually led to a flattening of the skew. So the skew on Thursday was 1.37, and on Wednesday it was 1.37, and on Thursday is 1.34. So the skew flattened a little bit, and you can see that over here from this dot down to this dot, it came down. And listen, it is very subtle, but these are kind of the subtle things that I'm always on the lookout for because they can give you little signs of what's going on below the surface. So I found that to be really interesting because I think it was an indication that the market actually wasn't too concerned, or not, it definitely wasn't in full-on panic mode. I'm actually going to go out of order here, and I'm going to jump to the tails from the tape section because I think there's a lot to be learned. I think we can kind of carry this fixed strike vol conversation forward into what was happening in the market itself. So I'm going to look at this is the S&P 500 futures. I'm going to take a look at a couple things of what happened on Thursday and into Friday that I think will be useful. So I'm going to pull up an intraday chart. So this is basically a one-day chart. All this is showing Thursday and Friday. And these candles each represent 10 minutes. So way over here, this is the end of the day Thursday. So as we can see, it's actually it's the full day Thursday. This kind of section over here was what was going on overnight. And then once the market got to opening, which was right around here, so this was the first candle of the cash session. So overnight, it kind of drifted lower. You can see down here, this is the volume bars. There was very little volume. Well, once the cash market opened, that's when the volume comes in. You can see the black bar down here. That was a big kind of punch in the nose. A lot of selling hit, tries to recover, and then sells off the rest of the day. And you can see it was a kind of mix of up and down, up and down, up and down. But then when it got down here, and I wanted to show this black line right here, this is just I'll call it kind of a technical level that I had highlighted. Sorry, I'm going to make it easier to see. It's a little hard to see with all this stuff. So, okay. So this is the black line that I was highlighting. And it's just a level that I noted. It kind of, price had struggled there. Then it broke through, came back through, came up and tested it. It just looked like an important level that price kind of struggled with on the way up and on the way down. It acted as support, acted as support, acted as support. So it was a level that I had my eye on. And so as we were moving towards it on Thursday, so again, follow my cursor, we were coming down towards it. I was watching to see what was going to happen with price and volume. As you can see, we got down here and we kind of bounced. Volume was still pretty steady, not a lot changed. But then as we came to the end of the day, so this is the last 10 minutes of the day on Thursday, we got a massive punch of volume, a lot of buying. Price dipped below the level a couple times, it kept holding, and then volume came in heavy to buy the market. So when I see that, and then later in the day when I saw the fixed strike vol, after the market, when I saw the fixed strike vol measures came in, it said to me like, man, like this just doesn't look like a market that's about to roll over. And another thing we can look at is the volume weighted average price. I'm going to change this to the day. So this is going to be this gray line. So we didn't actually get back above the VWAP for this day. And the VWAP is a measure that a lot of folks watch. So it's the volume weighted average price. And in a truly kind of bullish scenario, you want to see the price kind of recovered and closed above it. But it did on this thrust kind of make up some good ground and got pretty close to it. And then as we moved over into the next session, obviously it's a reset of the day. But then it just, in the overnight session, just kind of chugged along. But having seen at that point the fixed strike changes, and then having seen what happened here on the S&P 500, all this buying coming in, I also want to highlight what was going on in the VIX futures. So this is the December contract of the VIX futures. And so let me see here. Okay, so these are 1 hour charts, and I wanted to highlight, actually let's go back to the 10-minute charts. So I wanted to highlight what was going on. Where was this? Why don't this go back further? Sorry, give me 1 second. Okay, so what I'm looking at here, so this is Thursday. Over here's Thursday, and we had the VIX futures ramping all day long, and then as the day was getting kind of near the close, if you look down here, going into the final, this is the last 10 minutes before the market closed on Thursday, we got a massive selling order come through or selling pressure come through in those last 10 minutes. So just as the S&P was getting a huge, getting a lot of buying pressure, these VIX futures, which are still trying to spike, they kind of made another run up here. They got just thumped down on massive volume. So again, if the market was like really on the verge of like selling off, I wouldn't have expected to see such heavy selling of the VIX futures coupled with such heavy buying of the S&P futures, and then to later see what happened on the fixed strikes, in the fixed strike landscape, seeing that calls actually were bid stronger than puts. That was a lot to tell me that like this doesn't look like it's like the market is really about to crack. And so what we saw over the course of the night was VIX futures kind of moved sideways. They started to climb as we approached, as we got into the late Asia and then into the European market hours. And then as soon as, so this is the first candle of the cash session on Friday, as soon as the New York markets opened, you can see here, this is actually the first candle right here. VIX futures tried to ramp and then just got smashed. And you can see the volume really came in again here and then smashed again in the next 10 minutes. And then from then on, it was just like full on dumping of VIX futures. There was a couple rallies there throughout the day. But in the end, we closed lower, and I'll go back to ES. So this is the S&P 500. You can see as soon as this was the same cash open, sold off. That's corresponded with the VIX futures spike. Then wham, massive buying came in for like 30 minutes and just pushed the market back up here. We got back above that critical level I was watching. Maybe critical is overstating it. That, important level I'd flagged, came back, tested it, bounced, came back, tested it. And then this was coming right into the close. This was the final candle before the cash close. We had a big buying coming here again and closed back above that level. So in my mind, and I'm not trying to over emphasize this one, kind of technical price level, but it was all kind of it was all kind of part of the constructive narrative that was starting to build that Thursday sell-off wasn't actually kind of cataclysmic. So I thought those were all good signs, and I thought were worth sharing. So I do want to now move on. Okay, so for those of you who used to read my weekly notes on Substack, this chart will look familiar. This is the CME's measurement of book depth on S&P 500 futures. And so this is an interesting way to look at market liquidity. And so what we want to look for is high levels of book depth. A deep book is a sign of high liquidity, and high liquidity is something that helps markets kind of move smoothly. So when looking at this graph or this chart, high levels of liquidity or book depth are captured by kind of these red and green blobs being large. So on the upside is the ask, and the bottom side is the bid. So when you have these large peaks and troughs down here, that's signifying a deep book. So I've also layered on here that this line is the bid-ask spread. And so when you have a wide bid-ask spread, so when you see this line shoot up, you'll notice it corresponds with drop-offs in book depth. Well, widening bid-ask spreads are another sign of strain in the system, of a little bit of stress. So when the reason I look at this is because when you see drop-offs in book depth like here, and you see spikes in bid-ask spread, it's a good indication that there's some stress in the system. So this is weekly data that I show here, and it CME on the weekly side produces the data on Thursdays. So each of these individual measurements is taken on a Thursday, and this goes back to the beginning of 2025. So as you can see, we started the year off with decent liquidity, good book depth, low bid-ask spreads. Then going into March and into the April sell-offs because of the tariff issues, you'll see that the book depth dropped off, and we had a spike, and we had spikes in bid-ask spread. So really looking ahead to today, as you can see, basically liquidity has been increasing pretty steadily throughout the year. We've had drop-offs in book depth, and we've had little spikes in bid-ask spreads. But generally speaking, where we are now is a pretty healthy level. So this feeds back again into my overall takeaway of where we are in the market right now, where things look pretty good. And it's it's not abnormal to see dips. There is some cyclicality in this that I've noticed, depending on the expiration cycle in the futures. But generally speaking, where we are now, this measurement of liquidity looks pretty good. So I'm always on the lookout for this to roll over in terms of book depth, or for bid-ask spreads to pop. And right now we don't have a situation that's overly worrisome. Okay, so now we're going to take a look at the MOVE index. So this is Treasury market volatility. And the Treasury market volatility is something that's important to keep an eye on, because when there's volatility in the Treasury market, it can be a sign of pretty significant stress in the broader system, and not just the U.S. system, but kind of globally as well. Treasuries are used as collateral throughout the world, and so when the instrument you're using as collateral has low volatility, that's a good thing. When an instrument that's being used for collateral has high volatility, that's not a great thing. It can lead to margin calls and a greater destabilization in the market. So low Treasury market volatility is something we kind of want to keep an eye on. So what I have shown here is we have this top pane is the TLT, which is a very popular 20+ year Treasury bond ETF. That's less of what I'm going to be focusing on right now. What I really care about is this bottom pane, which is the MOVE index, which was developed by Harley Bassman. And as I've written here, it says the developer, so Harley Bassman, says that the normal range is between 80 and 120. So that's what these red lines are. The top red line is 120, the bottom is 80. So as you can see, the MOVE index does generally live between 80 and 120. This is going back, this chart is weekly data going back to the beginning of 2022. So this is basically 3 years of data. And as you can see, we got spikes, and then we can move back into the range. And then as you can see right now, the move index is actually very low. So you can see the last kind of pop we got in the move index up above 120 was back in April when we had the tariff stress. And then once the market kind of stabilized, and as you can see, we've basically moved sideways since April. So we got back up to this kind of upper, or this is kind of the lower bound of resistance. We've kind of pulled back, and we've seen Treasury bond volatility start to move up a little bit. But generally speaking, since the tariff stuff back in April, Treasury market volatility has just been straight down. And so, the good thing is that Treasury volatility is low, and we like to see low Treasury volatility. It's a sign of market stability. I'd say maybe not bad thing, but the thing that I'm keeping an eye on is the fact that it is so low and that it's starting to climb. And so, periods of low volatility feed on themselves and continue to keep markets very volatile. But eventually, periods of low volatility tend to lead to periods of high volatility. So that's what I'm on the lookout for. Even if the move index climbs back up into this range, that's not necessarily, say, a bad thing. We want to see is like how quickly it moves up if it does, how far it goes. I say this in other contexts as well, but it's less important where a market goes than how it gets there. So that applies to bonds, that applies to stocks as well. And that's where you'll see the measures of volatility pick that up. So if treasuries just drift lower without any real spasms or whatnot, the move index should remain relatively contained. The issue is when treasuries and equities and whatnot all move very fast. That's when the volatility measures pick up and things can kind of spin out of control. So as of right now, this measurement looks good. It's not showing there's a lot of stress, but because it is so low, there's a good chance at some point that it's going to be climbing higher, as it is now starting to do. And we want to see if it does climb, how it climbs. Okay, now let's move over to credit markets. I want to take a look at a couple things real quick. Actually, I'm already in the right thing. So I think I have highlighted this before, so I'm going to clear this out. It's a little easier to read. This top pane is the HYG ETF. It's a high yield bond ETF, very popular one. And the bottom pane is the S&P 500. I think I took something off that I wanted to leave. So yeah. And so I watch this because the S&P 500 and the HYG, or high yield bonds, tend to have a high correlation. So if you look at this chart, this is a weekly chart going back about 3 years. This bottom pane down here is the correlation. The dotted line is 0. As you can see, they are almost always positively correlated. It does dip to negative correlations every once in a while back to the 0 line. So basically 0 is about as low as it has gone. And when it does that, I'm usually on the watch for something being amiss, and there could be a change coming. You can see this last time here when it went down to the 0 line, the S&P eventually kind of rolled over. And here credit kind of rolled over too briefly. So what I'm watching for here is, and what caught my attention a few weeks ago, is if we look up here at the top, between the end of September and the end of October, the HYG printed a lower high. So up here, you can see the red line highlighting that it didn't get quite as high in late October as it did in late September. Yet at the same time, the S&P was making new highs. So that's a pretty slight divergence, but it is something that had my attention. As you can see, since then, the correlation has dropped. The correlation is getting pretty low. It's getting relatively close to 0 right now. It's printing at about 0.2. So when the credit markets and the stock markets diverge like this, it's something that I consider worth watching. And there's been a fair amount of talk about credit markets possibly being the next trigger that causes like a big broad market sell-off, whether it's private credit or elsewhere. I don't know. I'm not an expert in that realm, and I'm not sure even those who are experts are able to read the future. But generally speaking, this caught my attention as something that I'm keeping an eye on. And sticking with the credit side, there are a few other things that have my attention. So this first chart is a similar product to the last one. So this is HYGH. It has an interest rate hedge built into it. And so why that's important is with credit instruments, there are two of the main risks are interest rate risk, and then kind of credit worthiness risk. And so if you if you add an interest rate hedge to this product, what it does is it isolates the credit risk. And so that's a kind of a powerful way to look at this high yield market, because I can also watch down here in this bottom pane, these are actual high yield credit spreads. So when this line's going down, it's showing a tightening of credit spreads, which similar to the bid-ask spreads we were looking at with the CME liquidity measurement. A line going down showing spreads tightening is a sign of a healthy market. And this line going up, as you can see, is when this had a big sell-off back in March, April. It led to credit spreads, in this case, kind of blowing out, getting much wider. And so this downward trend that we've seen is very constructive. What has happened in the past, going back to kind of September, is we've seen these credit spreads start to widen, and that's happening as this product, this HYGH ETF, has rolled over. And so I'm keeping an eye on this. Now, keep in mind, credit spreads are still very low. They are still very healthy. But with the divergence I mentioned earlier, and then we're seeing these credit spreads start to widen and this product start to roll over, it's again just something that has my attention. This is a very similar product. So this is the LQDH. So the LQD ETF, which we'll look at momentarily, is investment grade bonds, and LQDH is the same but with an interest rate hedge. So I have it written out here. So this product actually helps express a cleaner view on credit spreads. So as we can see, similar to the high yield, this has rolled over. We can look down here. This pane is showing investment grade credit spreads. They have been climbing again, similar to what we saw in the high yield. So credit spreads are widening. And then this bottom pane, where I look at the LQD, so look over here, you can see the LQD and the IEF. This is a ratio of investment grade bonds, and IEF is, I think, the kind of midterm 7 to 10 year expiration Treasury bond ETF. So this is looking at liquid, which is would be considered a measurement of relative to Treasuries. Even though it is investment grade, it would be considered a higher risk corner of the credit market. So we're looking at this is a good way to measure kind of appetite for risk. So if this line is going up, it's showing that there's greater demand for investment grade bonds over Treasury bonds. And if this line's going down, it's showing a greater demand for Treasury bonds, Treasuries, as opposed to investment grade credit. So the fact that this line has been dropping for about a month or kind of 3 weeks, is another sign that demand is moving away from higher risk credit. And as that's happening with credit spreads widening, these products rolling over, and that divergence in the HYG S&P that I showed first when I started the credit section, those are all things that just have my attention. Again, credit spreads are still very low, so the market generally is quite healthy. And I also want to strain this. The credit markets are not something that I have some background or expertise in. These are just high-level measurements that I'd like to keep an eye on, because they can give you little signs or significant signs that something is amiss. I wouldn't go so far as to say anything is like strongly amiss by these measures, but we're starting to see markets turn in a direction that is worth keeping an eye on. Okay, so next section we're going to jump into is this week's tweets. And oops, that's not what I meant to open. The things that I want to highlight this week, so right here is Mondays, and I'm going to kind of go through this pretty quickly, but the theme early in the week was rotation. So when we opened on Monday, there was some initial resolution or apparent resolution on the government shutdown, and that sent a surge into markets. The market was led on Monday by the NASDAQ, by the semis, and the mega cap stocks, and that sent the volatility measures all plummeting. And what happened then into Tuesday and Wednesday, which were kind of the focus of my social media post, was that we saw rotation out of the NASDAQ and into the Dow, the Russell, and the major banks. Some people would say that that's not a good thing, because you want to see tech lead the market higher. In some ways, I would say that's probably relatively true, but what I care about more is rotation. I think it's a healthy thing to see the market go from strength in the large caps and tech in the NASDAQ to rotate its way into the Dow, into the Russell, into the banks, other pockets of strength, so that the leader can kind of take the day off. And we saw that on Tuesday. And most importantly, when we see that type of rotation, what I'm looking for is how does the volatility market react? And on Tuesday, we saw that this rotation the volatility market had no problem with that. The volatility market, the VIX and whatnot, they kept sliding lower, even though the mega caps and the NASDAQ were taking the day off. And we saw that rotation continue into Wednesday. So to see here, another sleepy start for the NASDAQ. But vols didn't care because the Dow Jones and the banks and the Russell were strong enough. And the other thing that I highlighted on Wednesday, and this is getting back to what we were talking about earlier in the video, was that I highlighted that this is when we saw there was kind of a jumpy start to VVIX, and this was tied back to the broader measure of implied volatility on VIX options. And so if you're following along throughout the week, I try to keep these things updated. I like to give my morning market read on what's going on, and I will highlight some of these signals that I catch that I think are having an impact on the market. And we saw that move over into Thursday. So we had that VVIX pop on Wednesday. Thursday, we got some early weakness. Volatility market started to bounce. And then what I was looking for, and I think this is worth explaining a little bit more, it kind of gets the rotation part of the conversation as well. The market was generally weak, except we had Meta and Apple, which I highlighted here. They were green. It looked like Netflix was trying to join. And so sometimes in order to keep the market steady, all you really need is a handful of like the largest companies in the world, like the Metas and the Apples, holding up. And so in this case, what I was looking for was, did any of the other mega cap stocks, or maybe some of the banks, did any of the other influential pockets of the market, did they flip a few of these big companies to just remain steady long enough so that other areas of the market could kind of catch on and stabilize? And when that happens, oftentimes you'll see vols roll over and take a nosedive. And so I was on the lookout for that. But what happened was, and I provided an update later in the day, was that instead of other strength emerging elsewhere to join Meta and Apple rolled over and flipped green. And once that happened, once there's kind of no area of the market that's holding things together, that's when volatility is going to start to move. And that's exactly what we saw. We saw the VIX spike, and the rest was history going into Friday. Now, what I want to also highlight here is that, and as I was getting into earlier, there was some early concern on Friday because of the follow through onto the downside, especially overnight. But as we saw pretty quickly, and I highlighted in the tape reading section, was that we then saw strength come into the market late on Thursday, and that was an interesting signal that Friday's sell-off was going to be short-lived. And so that was my kind of final thought down here, that despite the selling, the close on Thursday was actually decent, and that it was worth keeping an open mind that the Friday morning dump may be this kind of one final shakeout before equities turn around. And that is so far what has happened. We'll see what happens on Monday, but so far so good. And so this is just kind of a quick look at what was going on my social media posts. I figured there's probably an opportunity worthwhile opportunity to explain some of these posts more clearly on the weekend videos, because I know some of them might be a little bit harder to follow in real time. But as always, please, if you're following these things, shoot me a message, ask questions, make comments, whatever you want. I'll get back to you if you don't understand what it is that I'm pointing out. Okay, so I think that's basically it. The last thing I did want to highlight is that going into this coming week, the November VIX futures contract expires on Wednesday morning. And so why that's important is because it's going to lead to a shift in the VIX futures board. As we can see right now, November, it closed the week at 1990. December closed at 20.15, so that's only a 0.25 vol point spread, so that's very thin. I don't normally, as you know, I'm always on the watch out for the futures board flattening out and then inverting into backwardation, which would mean November is higher than December, December is higher than January. Right now, because the front is so flat, but we're so late in the cycle, meaning that November is about to expire, this flatness doesn't bother me so much. What I care more about right now, because after expiration, December, the December contract is going to be the front month and the January contract is going to be the second month, I care more about this spread, so 20.15 to 21.28. So we have about 1 vol point between the two of them. That's decent. It's not great, but at least there's some spread there. What I'm really more focused on also, in addition to that, is that VIX itself, spot VIX, is very close to the curve right now. And so what I mean by that, and I'll go back here. So what I care about, this green dashed line right here, sorry, there's always ads. This green dashed line is the spot VIX. The blue curve is the VIX futures curve. As we can see, VIX itself is very close to the curve, especially the December contract. I'm going to widen this out. So this gives a cleaner representation of what it looks like. The curve is relatively flat, which is obviously something that has my attention. And also the fact that VIX is so close to the December contract has my attention. So I'm going to be watching that. Ideally, what we want to see is VIX start to pull away lower to the downside, and that will take some of the pressure off of the VIX curve, and that will help the VIX curve steepen and continue its march lower. So that's what I'm looking for. We've only got, you can see right here, 0.32 vol points between VIX and the December contract, which is pretty thin. So, on Monday, we're probably going to get a mechanical pop in the VIX, and unless the market opens really strong. So that pop may close the gap with December, but then we want to see how it responds afterwards. And because December is going to be so early in its expiration cycle, when it's going into this week, it's still going to have over a month until it expires. It's not going to chase spot VIX around very closely. So even if VIX does spike on Monday, whether it's because of the mechanical pop and or because of market weakness, how December and January and February contracts respond is going to be the real tell. I'm not going to worry too much about what VIX itself is doing, and I'm certainly not going to worry much about what November's doing, because the November contract expires so soon. It's just going to chase VIX around. So so anyways, that's what I'm going to be looking for into next week. Generally speaking, it all things considered, we had some volatility this week, but I think the market handled it pretty well. We had really constructive closes on Thursday and Friday, so I think that's a good sign. And we'll see what happens. So I hope you have a good rest of your weekend and early start to the week. If you have any questions or comments or feedback, please do share. I read all those things. We got some feedback last week about the volume being a little bit low. Hopefully that's been resolved now. And in the meantime, just be safe out there. And thank you again to Macro Ops for the collaboration. If you are watching this because you're part of the Macro Ops community and network, welcome. Please spread the word. If there's anything you want me to explore further in these videos, please let us know in the comment section. You can find me on Twitter at X at Vixed Signals, VIXED SIGNALS, or on Substack at The Free Dominion. We will include those links in the video description. And that's about it. So until next time, be safe out there and good luck.